the feed's running correctly.
All right.
All right. So it looks like we're up. And we will get going in just about 2 minutes.
Okay.
Is there anybody logged in?
Let's see. So it won't tell me actually until the program officially starts at 7. So everybody right now is still looking like a no, but that's just because we haven't gone anywhere yet.
Well, we can give it a couple minutes too to kind of
give people a chance to jump in.
I know Steve Daly texted me earlier and he was like,
yeah, he said, oh, we have a comment. Let's see what we got. Nan says hello. So we have some people watching. Excellent.
Hi, everybody.
Hello.
We will be getting started in just a few minutes.
Oh, Chris is on. Hi, Chris. All right. We'll be getting started shortly.
Okay, standing by. Good evening, everyone, and welcome to Real Estate and Financing in the Merrimack Valley Residential Market. My name is Mike Mitchell, Assistant Director of Alumni Relations at Salem State University. We're very excited to have you with us tonight. We're looking forward to a great presentation with Jess Tomlinson, a realtor in the Merrimack Valley and Southern New Hampshire area, with Coldwell Banker, and Chris Donovan with the Mortgage Network. So at this time, we're going to go ahead and welcome our producers to the show and cover just a couple of quick housekeeping items. For those folks that are joining us, we want to let you know that in the lower right-hand corner of your screen, there should be an option to expand your presentation to cover the full screen that you're looking at. We certainly encourage that for the broadcast this evening to make sure that you can take a look at all the good text that's in this presentation as well. Whether you're watching on the Learning Consortium page or through YouTube, we also encourage you to ask questions. We'll answer those throughout the program. And with that, I am going to turn it over to Chris and Jess. Thanks very much for joining us, both of you. We're looking forward to a great conversation tonight.
Thanks, Mike.
Thank you, Mike. We're excited to be here. I'll get started. So my name is Jess Tomlinson, and I am a real estate agent with Coldwell Banker. I'm out of the Haverhill office, but I'm licensed in Massachusetts and New Hampshire. I'm also a 2009 graduate of Salem State, so that is my connection to the university. I'm an alumni, but I'm also currently an alumni board of directors on the Alumni Association. So it was an easy ask for them to, rope me into this program, which I'm excited to do and provide some value back to the community and to the alum. Beyond real estate, before I got into real estate, this is about my 4th year actually doing real estate. My background's in affordable housing, and actually, fun plug, Chris and I used to work together at the Hawthorne Hotel in Salem, in a different era. But yes, we work together differently in a different capacity. But so we both have great customer service experience, which is really important in this industry, I think. And yeah, I've been doing it for about 4 years or so, and I love it. And that's what I got.
Hi, everybody. Chris Donovan. I work for Mortgage Network out of the Danvers office. Similar to Jess, I am also licensed in Massachusetts and New Hampshire. I have grown up on the North Shore. As she said, we worked together at the Hawthorne Hotel. I've lived in Peabody. Now I live in Salem for the past pretty much 30 years, or my entire life outside of college. But no, Salem State, not that. But I went to Westfield still, a Mass State school. But my wife is a part of the alumni board. So, when Jess wanted to do this, she talked to my wife, and here I am. As a loan officer, I've been doing this now for 8 years. I started off with my company as a mortgage banker in training. So I learned the background of it, the processing, underwriting, pretty much the nuts and bolts on how to get a loan for everybody. Since then, the last 7 years, I've now been pretty much originating all of my own loans, helping people, like I said, in Massachusetts and New Hampshire, to find their dream home, refinance, invest in multifamilies. There's multiple things that you can do with real estate, not just, buy your main home. So that's what, Jess and I are going to be here talking about, and looking forward to get ready for it.
Awesome. So just to kind of remind everybody, I think most of those that are signed up tonight are either first-time home buyers or just really starting to think about getting into the process. It might even be 6, 12, 18 months or more out. They're just curious about, what is this process? How do I do it? Why do I do it? Why is it important? So there is a chat feature, so please feel free to, if you have questions for us. We can't hear you. And we can't see you, so I don't know if you're waving at me or not. So if you have questions and you need our attention, we are going to respond to them during the program. If you have a question about something that we are planning on talking about in the future, then we might just acknowledge it and then say we're going to talk about it later, but we definitely want to get some feedback from you. And then there's an opportunity after this program as well to connect with either Chris and I together or separately if you have personal questions. So I think one of the things that's really important about real estate is that there's a lot of individual circumstances, and this is a big financial decision. And everybody's finances is different, and please try and keep your personal finances out of the questions. They are public to everybody, but we're not going to talk about individual financial circumstances in this platform. It's just not appropriate, but it's definitely, we can talk offline about anything that you have going on. So this is also not an approved, accredited, licensed first-time home buyer class in the state of Massachusetts or New Hampshire. This is just strictly for informational purposes only. Chris and I are kind of here as a resource to provide some high-level process details about like, what is this, how we do it, and then also kind of give to a little bit of a market update as well of what we're seeing in the field, kind of some of the challenges that we're experiencing on a day-to-day from our clients, and just some experiences and circumstances that we might run into. So what other housekeeping things we got going on? Yeah, I think that's anything to add to that, Chris?
No, I think you covered mostly. Just as we said, just keep it interactive. You guys have questions, cool. As she said, keep them generic, but we're all ears. We're here to help you guys out. We don't want this to just be a lecture. We want to be able to have the group be able to ask questions, and we can kind of bounce some ideas off to you as well.
All right. Well, let's get started a little bit. So if we can go to slide 2, Mike. So what slide 2 is, when it does come up, it's the rent versus buying. And so for a lot of people, oftentimes, I can keep talking, right? Yeah. I'll just chat while Mike is figuring out behind the scenes. So probably a bunch of us are renting and are considering buying, or maybe we're living with family or we're staying with friends. Did we change the slides around?
Slide 2 on mine is, are you ready to buy a home? Purchase decisions.
Okay.
I'm going on the one I sent Mike. Sorry.
Got it. We'll go by yours. That's fine. So there's benefits to renting and there's benefits to buying. And again, it comes down to that personal situation. If you're planning on being somewhere for only 6 months, a year, 2 years, or you're planning on relocating and you're not going to be staying somewhere for a long period of time, or it's not going to be somewhere where you're going to be really putting down any sort of roots, then renting's perfectly fine. And it probably makes sense from that lifestyle perspective to kind of stay renting. But as you get a little bit more established in your career, or if you get a little bit more settled with a partner, if you feel like you're going to be somewhere for a while, considering purchasing might make sense. So if we can go to the rent versus buy slide. Oh, that's fine. You can stay there. All right, that's fine too. So typically when you rent, you will more often than not spend more than if you purchase. So and there's a couple of reasons for that. When you are renting, there's very little stability in your cost. So rent can go up at any time the landlord feels like he or she wants to raise the rent. If your lease ends and he no longer wants you in the apartment, they can ask you to leave. So there's kind of a lack of stability there, versus when you're purchasing something, there's some more long-term longevity to your space, and you have control over, how you're choosing to live. Your mortgage is going to be like a fixed rate. And I know Chris is going to kind of talk about that a little bit more when he gets into his mortgage part. But one of the main pieces on the renting side is that you're paying somebody else's mortgage. So you're paying down their equity. You're paying them and lining their pockets in some cases. They're getting a little extra cash flow from you. And there's really nothing for you to show for it. And there's no true benefit long-term for you to be renting in most cases, unless it's a short-term transitory type of situation, or you're not in a position at that point where you have like financing in place or the money available to put for a down payment. And so long-term renters retire later, sometimes never retire. Long-term renters tend to move around a lot more because they have to they're not always guaranteed housing. And there's like a lot of other like financial factors too, from like a retirement asset net worth aspect of it that, you know, plays into this too. But for the most part, you're going to pay more on rent than you are going to be on a mortgage. And there's more stability in purchasing than renting. You have anything to comment on that, Chris?
You pretty much hit the nail on the head. Just as you know, you said the only changes, at least with the mortgage side, especially if you go with a fixed rate mortgage, your principal and interest is never going to change. So, you know, you're going to know pretty much your monthly payment. The only ideas that could change is homeowners insurance and taxes. Taxes will change every year. They come out quarterly, at least around in this area in New Hampshire. You guys have taxes semi-annually. So, you know, those could be something, but for the most part, as she said, I mean, I lived in downtown Salem for 4 years, and our landlord changed our rent on us 5 times in 4 years. One of them just 6 months, even though we had a full year lease. They said, sorry, it is what it is, and they bumped us up by $150. So, you know, since we've moved here, we haven't had, you know, anything to really bump up except, unfortunately, property taxes. Those seem to like to go up, but you know, that's pretty much it. Our principal and interest, because we were in a fixed rate mortgage, stayed the same. So, you know, that's the great thing. And, you know, as she said, you're paying your landlord's rent. Well, you're paying rent, you're paying your landlord's mortgage. So every month you're paying, you know, $2,000, $1,800, $2,200, whatever it is. That's just money in your pocket that's burning. When if you were to be paying that towards your own mortgage, yes, you know, that $2,000, some of it's going to taxes, some of it's going to insurance, some of it's going to interest. But every single month, a portion of that is going towards the principal of the home. And it's bringing, you know, it's giving you equity in your home. You're getting equity every month that you make that payment.
Yep. So there's a couple of different types of property that you may consider purchasing at some point. The most common one is a single family residence. So it's a 1 unit, typically detached from something else. You might have a small parcel of land. Another popular starter home is a condo, which is 1 unit in a complex perhaps, or a small complex where you'd be buying a townhouse or a garden style apartment condo. So you're buying one of a chunk of the building. And then another item that we're not going to talk too much about, but I do want to just put a plug in there, is any multifamily investment properties that, you know, someone might be interested in having rental income along with their own residence. So someone might want to live in 1 unit and then rent out another side that they also own, and have that rental income kind of come in to help subsidize that mortgage. It's a great way to build equity a little bit faster. It is an investment, so the lending on it is a little bit different. I don't even know, Chris, if you included anything on multifamilies on this presentation or not. I don't think you did.
I don't think we did, but I can still talk about it a little bit. Some of these programs still, FHA, VA, they'll still do multifamilies, even with especially if you're living in them as primary residence, they'll still do them even with the minimum bar investments. So, right. You know, we can go over those a little bit in the loan programs, but yes, I can. We don't have something specific for it though.
No. And it's those types of homes right now have been really popular because people like the idea of having somebody help them with their mortgage. Mm-hmm. So those are generally the 3 different kinds of properties that are most common. First-time home buyers fit really nicely into purchasing a condo as their first space. Tends to be a little bit more affordable. It's smaller. It's manageable. You don't have a lot of times like outside lawn maintenance to take care of, or snow removal, or exterior maintenance, or roof work that you have to do. That's what you pay a property management company to do. Or, you know, but sometimes people like to just, you know, go straight forward and purchase a small house, and that's totally fine too. It just comes down to personal preference and also where you're looking.
Yes.
Cool. So the first step to any purchase is to get the pre-approval process. And so I'm going to kind of toss it over to Chris. I call this the golden ticket. So when you get your golden ticket from your mortgage officer, it kind of gives you the keys to work with an agent to start going out and going shopping. But oftentimes there's getting the pre-approval process, it can take some time. And sometimes someone thinks that they're ready and they might not quite be ready yet, whether it's they don't have enough saved for a down payment or their credit report needs a little bit of repair work. But the absolute first step, number one, unless you have cash, which 99% of us don't have cash nowadays to just buy a house outright, you're probably going to need help from a bank. And so someone like Chris is going to work with you, because Chris would end up being like a partner in this sense. So when you're thinking about purchasing, it's important to think about your team. Your team is a bank or a lender, your real estate agent, an attorney, as well as a home inspector.
Yes. So I'll jump in here real quick as Mike's getting to the two more, Mike. One more after this one. This one right here. All right. So, as she said, why be pre-approved? Well, the reason to be pre-approved is you're going to be working with Jess hand in hand. Jess is going to go and take you out and look at all these different properties. I mean, I always any clients that I talk to before their pre-approval, I say, go watch HGTV for a day. There's a couple of different shows where the realtors will take you out. I know I just saw Jess' face plant. But there's a couple of shows that they'll take these clients out to a house that they can't afford, and they show them this amazing, beautiful mansion, and all of a sudden the people are like, oh my God, I want it. And they're like, yeah, you can't afford this. And not only did you waste your own time, you wasted the realtor's time. So, coming to a lender first to get pre-approved is a huge step, because now what you'll be able to afford. Lenders are great on this, because what we won't just do is just say, okay, you can afford here. But also, if, we're going to see your credit, we're going to see your income, we're going to see your assets, we'll be able to tell you, hey, your credit's here. And what we could certainly do is, if we can increase your credit score just a little bit, you can afford, and we'll see a little bit later with a couple of different loan programs we have. Different programs have different minimums for credit scores. So, it will, broaden your purchase power. It'll broaden your program so that you can afford more. You can afford, a lower down payment option. You can afford an adjustable rate mortgage. We won't go too far into those, but, the pre-approval is key, because it'll let you know, all right, I'm going out with confidence. I can afford $450,000. So then you can go up to Jess and say, I can afford $450,000. And then Jess will then work with you from there and say, what are the areas you're looking at? Southern New Hampshire, Massachusetts, the Haverhill area, the Merrimack area, whatever it may be. You can then tell her, and, they have a great program called MLS that will actually, completely cut down the houses to exactly what you're looking for, 3-bedroom, 2-bath. But it really helps just you and the realtor out to just make yourself look that much more, stronger to the sellers. Because, especially in this market right now, we are in a seller's market, especially, here in the North Shore area and southern New Hampshire, pretty much anywhere just north of Boston is pretty much a seller's market as is. But then you unfortunately do have, the 5-letter word of COVID, that some sellers aren't allowing people to even come into their house without a pre-approval. They're not allowing you to even see the house, even if you could be saying, I make $250,000, I have no debt, and my credit's an 803. That's great. But some of these sellers, if you do not have, as Jess called it, a golden ticket, you're not even going to be able to step foot in the house, because they're going to want you to have at least gone to a lender to get yourself qualified, to see what you can afford, and have something to show them and say, I went to a lender. A lender reviewed my credit history. They reviewed my assets, my income, and they verified that I would be able to qualify for this purchase.
Sometimes, Chris, what I suggest for people is, if they're like, I get questions a lot, like, my credit's not that great, or I'm not sure I have enough saved up. I still recommend people to get a pre-approval, even if they're not like ready 6 or 9 months out, because I feel like it's a great baseline for people just to kind of get a sense of where they are today and give them some steps on like what they can do to strengthen their position. What do you think about that?
Absolutely. And just to answer this quick question, how long does a pre-approval last? It can last up to 90 days, usually last about when a credit report expires. But Jess is right. You do want to do this a little time before. I won't go too far into a specific client, but client of mine years and years ago, they bought a car. Credit was 720. She was all happy and everything, got the car. And it happened in between is she had a $25 collection that came onto her report. She didn't know. She came to me when she found a house that she was ready to buy and didn't come to me prior to. And her credit had actually dropped from the 720 down to the 635. At this time, this was years ago now. This was about 7-8 years ago. We couldn't do anything above, below a 640. We can now, but at that time we couldn't. So she couldn't qualify. And it was $25. You know, that brought her score from a 720 down. And she had come to me a couple times and I said, let me review your credit. Let me see where it is. And she kept saying, I went to the car company and they told me it was a 720. I'm all set. So I always say that to my clients is, as Jess said, you know, 6-9 months is a great kind of stepping off point because yes, you know, I mean, it may not be ready, but it's a quick turnaround to get you re-approved again. But at least this way, you now know what you can afford. And let's say something did pop up on your credit that you were unaware of, you now have that 6-9 months to fix. Because when you fix something on your credit, if any of you guys haven't already done, it's not a quick fix. You know, especially if it wasn't your fault. You have to fight tooth and nail with some of these credit agencies to actually have them admit that it was theirs. So, you know, that could be a month, that could be 2 months. But even if you were able to fix something quickly, technically it could be up to 3 months before you see the score actually gradually get better on your report. So as Jess said, that 6 to 9 month is kind of a perfect sweet spot right before you're ready to buy, because then I can show you where you currently stand. I can give you some ideas on what you could do to better your situation. Or, hey, at worst, I say, look at this. Your credit's great. Your income's great. Assets are great. You're all set. As long as you stay wherever it is, 6 months from now, you're ready to go. You know, so it doesn't hurt at any way, because even though you see those Credit Karma commercials, oh no, I pulled my credit. That's not 100% true. So the reason why I say 100% is if you get your credit pulled by multiple agencies, you know, you went to 7, 8, 9 different places, you know, in the car world, I always kind of say I hate picking on them, but you know, if a car company can't pull your credit and send it off to the banks, they'll send your information out to the banks and all of them pull your credit. And then that's when you can see a difference in your score. The CFPB, who runs my industry, they want you to be able to shop around. They don't want your credit score to be affected. So they have it worked out with the credit reporting agencies that a 30-day window, if you came to me and then you went to someplace else, your score wouldn't change unless you changed something within your credit. You missed a payment, you opened up a card, you closed a card, something along those lines. So they want you to actually go out and shop around, to look around, to not just, you know, this is my score and that's it. And you know, it's a scare tactic by Credit Karma. It's a scare tactic by some of them, but it's not always true that your score does change unless something else negatively or positively has affected your score in the meantime. And I've seen both ways.
I tend to recommend to borrowers to not get more than 3 pre-approvals.
Yeah.
Is that like, would you say that that's in line with the normal?
Yeah. I mean, I it's kind of, you know, would be going against myself, but I mean 2 at the same time, because I mean, if you get 2 that are kind of giving you the same thing, you know, then the third. But I mean, if you got one that was way different off than the first one, then I would say maybe go to a third, go back to the first, talk to them, find out what it is. You know, it's like I said, CFPB does not want you to feel like you're shoehorned in and that's it, and you're only there. They want you to kind of look around, because not all companies have the same programs. So some of them, as we're going to see later, you know, we have a lot of a broad spectrum of programs, but not all places do. Some of them, especially again, due to COVID, have scaled some of them back. Some of the programs just aren't even, you know, available right now. The same thing until, you know, we hopefully go back to some sort of normalcy. But hopefully, you know, that sounds like we might be in the step in the right direction there.
So when someone comes to you for a pre-approval, what kind of documentation are you asking from somebody to start?
So first we're filling out a 15-minute application. It's more of basic information, your name, social security, not credit score, excuse me, phone number, addresses, employment history, income, those types of things. The documentation that we need to verify, your employment, we would need, pay stubs, bank statements, W-2s, just to verify, because we need you to be working for 2 years. Or, Salem State, great example here is, well, you're not working 2 years because you're in school right now. So schooling is still technically work. So we ask you for your transcripts, show that you've been in school for the past 2 years. That works as the work history for the 2 years. And then you've gone off and you've become a nurse. You've become whatever the step is that your next step of your work history will be. And then we can move on from there. So typically we want a 2-year history. Obviously, if something came up, well, you were just having a kid and, you took some time off and now you're back in working, you write a letter that says I've had a kid and was out for 5 months or something along those lines. There's reasons that, we don't have to have the 2-year, but, if you, like I said, the bank statements, the pay stubs, those are really the big items to thank you, Mike. The bank statements are huge because the assets show what you can afford. Like we said, when we get back into a couple other, the programs, some of them have a 3% down. Some of them actually allow you to do 100% financing. Some of them require 5%, 20%. So seeing your bank statement, seeing how much you have for assets will be able to then tell you what programs you then would qualify for. And similar with the pay stubs, we'll be able to see what type of job history you have. As it says here, same line of work, multiple job changes. We'll be able to see that with the different pay stubs and W-2s, but, the instability of income. Do you work in a commission-based job that, unfortunately, this year hasn't been as well? Well, now we'll be able to see that and be able to explain, what happened with your income. Or did you go from hourly to salary, and there's a benefit, maybe you went from hourly to salary, you got a increase in your job, and we'll be able to see that as well. So there's multiple things on why we need to see the documentation, but it will help us be able to better understand your situation and show you a program that works for your specific situation. Because not all programs are just cookie cutter. Every one of them is different. How would your income be calculated if you're attending college? If you are currently working while in school, we would just see your pay stubs. If you're in school and then you're graduating, let's just say in the spring of this year, coming up in 2021, if you have a job lined up after you've already been after you graduated, they'll give you a signing letter. They'll give you something that says you're going to be getting paid $75,000 a year when you start this job. Then we can use that. If you're doing any type of part-time job, and same thing, and it's going to go to full-time once you graduate, similar, we can reach out to your work and your work can explain what it is. So other than that, when it comes to if you're doing 2 part-time jobs, we would have to take an average of them and kind of show you what you could afford depending on how long you've been working there. Some of the part-time jobs some of the programs need 2-year work histories for those, for second jobs. So it's a little different with every different work, especially if you're still in school. So that one's a specific on how your situation is.
Oh, I love credit scores because people, this is like, I get this question all the time. Why does my credit score matter? Or sometimes I work with, some tenants that actually don't have credit. Or like, and a lot of times there's just a very big misunderstanding about what a credit score is, what it does, and what it tells an institution like a bank about somebody's personal financial habits. Right, Chris?
Correct. Yes. So as this slide kind of says, there's 3 different credit bureaus: Equifax, Experian, and TransUnion. And if you, use, and this is not a slight with Credit Karma, Free Credit Repair, or Free Credit Report, excuse me. Capital One has CreditWise. All of those are great, but what those are considered soft pulls, and they're just going to give you an idea of where your score is. But any major company that's looking to lend you money, whether it is a mortgage company, a bank, car industry looking to pull, lend you money for your car, they're going to do what's considered a hard pull, and they're going to actually look at your entire history of your credit. So they're going to see all the way back to when you got your first credit card when you were 18. And that score is where they're going to then be able to lend. So, Mike, if you actually scroll down one more, your credit score is here, 740 and above, you're excellent. 680, you're good. 620, fair. Anything below 620 is poor. But I got distracted by this question.
It's a good question.
It is a good question. Yes. So anyone in my industry, I can't speak when it comes to like cars or anything like that, but anybody in my industry for mortgages, we would actually use the score of 680. Now, the 765 is considered a compensating factor. So if you guys had some other issues, whether your income was a little low or you guys' down payment was a little bit minimal or something along those lines, the 765 would be able to benefit you and help you still be able to qualify. But anybody in my industry, we take the lower of the two middle scores. So we're going to get 6 scores, 3 from each of you, and the lower, so that in that situation, the 680 would be the score that we would qualify you on. Now, as you can still see, 680 is still a good score. There's nothing wrong with the 680. All credit scores are based off of, your history. There's another one. Here we go. Mike, if you can go down 2, please. Oh, it's actually that one. There was one in the middle for some reason. I missed. So it's this graph right here. Your payment history is 35% of what makes up your credit score. So if you keep on making your minimum payments every single month, that's great. But if you could actually start making, a couple of extra payments towards the principal, it'll actually help out. The amount owed is another 30% because, credit card's a great example. You can run your balance all the way up to the maximum, and they don't really like that for the credit score wise, because now your limit is right there, or your balance is right up to your limit. If you ever needed that credit card, you didn't have any wiggle room. So those two are the two biggest pieces of the pie, because they want you to be able to make your payments on time, but also to show that you are a trustworthy, credit-worthy client with having, it's, doesn't have to be all the way down to 0. You can run a balance. The sweet spot with running a balance is 30 to 50% of the limit, because then it shows that you can run a balance, you can make the monthly payments, you can, keep a balance, keep it current and not ever fall late. But it also shows that, I live my life. I can't always pay it down to 0. I have other bills I have to pay. So the last, couple 3 are the length of the credit history. That's a huge one with some of, I'm only 33 years old. So I was in college, 10, 12 years ago now. But I didn't have credit when I was coming out of college. I had my 1 car payment. And then when I went to go try to get my credit pulled, I didn't have a score because I only had 1 trade line, but also the limit, not the limit, the length was short because I just got the car and it was only about 1.5 years and it wasn't that long. So even if you were to get, say, a credit card and you keep it at a 0 balance, but you keep it open, they do like those length of credit histories. They like the fact that you have something currently open.
My very first credit card I used for gas in my car only.
Mm-hmm. That's what I ended up doing with mine after, once I found this out, is I got one for just groceries. So.
And then I got a Kohl's credit card and I used it when I bought clothes at Kohl's, and then I paid it off. And that's how you kind of like start building your credit in that way. But it's, I think, really important just to remember, like, to keep your, having a 0 balance is great, but like being able to manage all of your deadlines for when your payments are due are also really, really, really important. So when you don't make a payment on time, it very much negatively affects your credit score, to the point where if you have multiple is it a 12 or a 24-month period?
For lates, each program's different. Some of them are, they don't really want you to have 1 late within a 12-month, but some of them are 2 lates within the 24. So each one of them is kind of different. But again, it's, sometimes you can explain those lates off. I had a client at one time, it was that they set up the auto bill pay, but then unfortunately the debit card that they had to pay that credit card had unfortunately gotten hacked. So it got shut off. So, it's not, just black and white. Here are the lines and that's it. There is gray area. There is areas where if you can actually explain to us, this is what happened. Everybody's human. Everybody makes mistakes, and we can certainly see what we can do to kind of, rectify the situation.
Okay. So for pre-approval, you're pulling credit, you're looking at assets, you're looking at income, and what else? Is there anything else that you're doing?
We're also doing a couple of like background checks, verifying that you don't have any other, if you do, you may have answered it to us already, but if you have any other liabilities that may not be popping up on the credit report, child support, divorce decrees may pop up and let us know. But also, I had somebody one time that he was a junior and his father's house actually popped up on his credit report and he had no idea. So when, we were doing a background check on it, it didn't come up on the credit report there, but the background check showed that he owned a second property in Florida. Well, he didn't actually own it. It was the father and he was a junior. And, so it's similar. This is why you come to us 6-9 months advance, because, he had no idea that was the case. And then it took a while for them to actually report that correctly on his father's credit report and not his. So, those are just things that we are really looking at, is just trying to qualify you, see where you stand, but also benefit you if there's anything we can see that you could potentially help you.
Cool. So once you've got your pre-approval letter, then you go out shopping, which is why I call it your golden ticket, because it's usually very, very, very exciting when you get your pre-approval letter. Everyone's like, oh my God, I'm so excited. I have all this money. I can go out shopping. And then right now it's a little defeating for folks. And I had this buyer recently, and we did find a place for them. They had a 450 pre-approval, and they were looking in Southern New Hampshire. And I think they really thought, like, on the very, very, very first day of going out on Saturday, that they were going to buy something by the end of the day on Saturday. So it was a little disheartening for them, because one, they didn't find what they thought that they wanted. But it was a great exercise for us to kind of get out there, start looking, start peeking at, what kind of things are in that price point in the communities in which they're looking at. And it's a conversation more so. So my role as an agent is to help guide and educate. And then sometimes I ask really difficult questions. So for these particular buyers, the difficult question for them was, how important is it for you to live in this community that you want to live in? And it was a really hard conversation between this couple, because for what they wanted specifically and what their pre-approval was, it didn't match. So what they could afford, even though they had a generous budget, what they wanted wasn't in their budget. So we had to have another conversation about, okay, well, are you open to other communities? Are there other areas that you might be interested in looking at? How flexible are you about your geographic region? Or are you willing to compromise on amenities? Do you need a pool? Do you need granite countertops? Do you need recessed lighting? Are those things that are important to you? And what are we willing to compromise on? So even though sometimes you get your golden ticket and it's very exciting, we have to set some realistic expectations too, like in the first couple of visits. And it's important when you're going out to be an open mind. And I actually just said this earlier too, is like HGTV has ruined a lot of buyers, I feel like, because you're laughing because it's true, right, Chris?
Yeah.
So like on HGTV, it looks so easy, right? You just go out, you pick 3 houses, you look at 3, and then you pick one at the end of 45 minutes and you buy it. And it's just totally done and simple. That's not real life. And also, like, a lot of times the houses that are in those areas, they're beautiful and totally done over, and they're like $150,000 because they're like in East Butt, Midwest somewhere around nowhere, and that's just not realistic with our area. So setting realistic expectations and kind of deflating the balloon a little bit is mostly my job. But
it's an eye opener.
It is an eye opener. It totally is. And it actually is it's a process, and you have to be patient about finding what you're looking for, and then being open-minded is really important, because if you go in with an expectation that you want something, and then you're like, oh, like maybe I don't want it, or you actually see it and you're like, I thought I wanted it, but maybe having a yard's not important to me. Or having a yard is very important to me. And there's been a lot of that actually since COVID, is readjusting a lot of the expectations and priorities for people. I know I'm seeing a lot of people that are moving out of condos and to single family houses. There's a lot of people looking for yards or bigger yards, because everyone's at home, or if people are doing homeschooling, they want, some extra space in the basement or an extra room to do homeschooling, or some sort of flexible room or a rec room. That way people have place to either work from home or do like extra reading time. So there's been a lot of adjustment in the last 6 to 9 months. No, it's okay, Mike. I'm just going to chat for a minute. So there's just been a lot of like realigning on what the priorities are for people. And it's been an interesting process sociologically too, like how, like as a, just as humans, like what we're needing and how we're going about getting it. And housing's been all part of that in a very unique way. And forcing people to move sooner than they expected to, and then some, keeping people hanging tight where they wanted to move before. So yeah, so that's kind of the house hunting process. When my next thing is making offers. So when you do find something that you like and you want to make an offer on it, the process of making an offer is one part presentation, which is partly your agent, right? So like it's my job to sell you as the best buyer for the house. So having your pre-approval with Chris or another lender is super important, because that already that helps me advocate for you that you're financially strong and capable in order to be able to purchase the seller's home. If I am using the best interest that I have, that you've like gone through the financial process. So as part of your partner, and your lender is your partner, I work very closely with your partner to make sure that I understand to the best of my ability what your financial capacity is. So when I'm submitting your offer, I'm selling you as the best person. And there's other things too that go into that process, but one part presentation, one part financial contribution. So there's deposits that are made with submitting an offer. Sometimes people like to submit a love letter directly to a seller to kind of appeal to, on an emotional side, about why somebody wants to buy their home. And that does work quite a bit in the market. You have to kind of know who your seller is a little bit and what their situation is to make sure that it's compatible. But there's been a lot of success in offering love letters.
That worked for us.
Did it? Yeah. They're actually pretty controversial, the love letters, in like the real estate area. I personally like them. I have pulled love letters last minute after I've learned that like either sellers were going through a divorce or they've lost a child or something like that. And so like, because oftentimes the love letters along the lines of, they're very excited about the home. I can see myself in your home. Like it's perfect for me, right? And everyone has like their own words. If it's a rehabber or a flipper or an investor that owns the home, they don't care about your love letter. They don't, right? Like they don't care. But so you kind of have to know who your audience is too, in order to be able to be putting that presentation together. And your offer is one part price. So the price for the home, as well as the terms. And so your terms look like what kind of contingencies we're putting in place. Is it a home inspection? Do you need financing? Is a washer dryer included? Do you want the snow blower? And when do you want to close? Is it 45, 60, 75 days? Do you need time? Do they need time? So all those offer components are important when you're presenting it, because you have one shot oftentimes in this market to make a really great impression. And great first impressions are important. So
just say on hers real quick, that on that offer of the snowblower or the washer dryer, I mean, you have to actually put in everything, because there was a chandelier for one of my clients one time that they thought it's bolted into the house and whatever, and didn't put it on the offer. And the people took it when they left because it was an heirloom from a grandmother or something along those lines. And the buyers were mad because they thought they were getting this really nice chandelier. So as crazy as it sounds, anything you can say, we would like this left and this left and this left. The first time you put it on there is better versus trying to, fight after the fact.
Yeah. So I'll talk. Oh, we have a question. Good question. Knowing kind of the market in that area is oftentimes very helpful. Sometimes you have connections with other agents in that particular community, and being able to connect and network with other local agents can be really helpful as well. There's a lot of agents kind of all throughout the state. Being licensed in Massachusetts, I can support anybody in Massachusetts. However, there are some limitations geographically sometimes. Like it would be hard for me to get out to Springfield to do showings. So if it's not something that I can do, the nice thing is that I have a network of agents that I can connect you with. That way they can support you in that community because they're going to know best. Generally speaking, I tend to stay within hour and 20 minutes of Haverhill. That's kind of like my bubble. So I'll go kind of as far north as like Concord, little north of Concord. I'll go out to Portsmouth, New Hampshire. I've done Rochester, New Hampshire. I'll do Worcester, and then I'll kind of do some of the South Shore. I can't do the Cape as well, just because it just really takes a long time to get there. And then I do special circumstances for friends and family too. Just kind of depends on the situation. But it is important to, I think, be mindful of that, because if someone's going to be spending a lot of time with you, going out shopping on the weekends, Saturdays, Sundays, weeknights, right now, it's not uncommon for something to come up on the market and then for it to be gone within 5 days. So there is some timeliness associated with going to look at property that fits your criteria. Once you've kind of gotten all of your ducks in a row and you're ready to go, sometimes you got to go. Like if something comes up on Wednesday, if you wait till Saturday, it might be gone. So going and looking at that property right away could be in your benefit.
And to kind of second Jess is that, with her working Coldwell Banker, they're all over New England. So, if she can't help you because it is geographically out of her area, she can, refer you to somebody that can help. But it's great because, and maybe Jess, you can, elaborate on it more, is if you all of a sudden were in Central Mass for 4 or 5 houses and then you decided to come back to the North Shore, well, you're still with Jess versus trying to find somebody now in that area on your own. You would still want to reach out to somebody that's kind of here in this area and let them refer you out, because then you have both people now trying to help you, whether it is in Central Mass or Springfield, but also here in the area. So it kind of helps you out versus okay, well, I have somebody here in the North Shore area, let me go get somebody down there. No, tell your North Shore area agent that you're also looking in these other areas, because they can put you in contact with somebody, and then that way you feel like you're really being taken care of, because now you have, 2 people helping you out on that.
And even more so, I'll stretch that just a little bit further, even out of state referrals. I've placed a lot of referrals this year to Florida, believe it or not, which is interesting. So I had somebody that I was working with in the North Shore, and we were looking in Nashua, and we were looking in Hudson and Salem, New Hampshire for a small house or a condo. COVID hit, and she was 100% working from home. She decided she wanted to be closer to family, so she got on a plane with her son and went to Orlando and thought she was going to come home, but decided not to. And so she called me. She said, "Jess, I'm so sorry. I'm not going to be able to work with you anymore. I'm really devastated. I loved working with you, but I think I'm going to stay here in Florida since my job is totally remote and they're not calling me back to Boston. I'm going to stay here, and I think I'm going to buy a place." And I said, "Okay, well, do you need help?" And she said, "What do you mean? You can't help me down here." I said, "Of course I can help you down there." And I placed a referral for her, and she closed. And I personally interviewed the agent to make sure that it was a good fit. And she ended up closing on a condo in October. So it worked. And then she called me. I got the same photos of her closing and signing and keys in hand. And she was really, really cute and she was super excited. And I sent her a gift and she even said, she's like, if I ever come back, like I'm gonna, I want to come back and work with you. And I said, great. But I was able to help her make that connection versus her going out trying to find somebody on her own, so that's a good point.
Yeah, that's similar in my world as well. I'm licensed in Massachusetts and New Hampshire. Yep. Not having to know the geographic area as much on my end isn't as important. Well, not important, but as strict because I'm more the money guy. But if you are looking in Vermont, Maine, my company, we're licensed in 28 states, mainly all the way up and down the whole eastern seaboard, and then we kind of go out into the central and western part of the country. But so similar thing. If you all of a sudden have a second home, or as Jess said, your family had to relocate, your job switched you down, and you're down in Tennessee now, you can certainly still reach out to either one of us. She can put you in contact with the Tennessee agent, and my office, we still have people that are licensed in these different states that I can certainly help you and put you at least with somebody that will be able to help you from start to finish. So you're not feeling like, oh my God, I have to go out and start from scratch again. It's a great feeling to know, they can still help us out.
Definitely. So I'm going to do a quick market update, and I think I need slide 7, Mike. Let me just make sure that's the right one. Yeah. No. How did we mess up these slides?
Mike, go up. I feel like Mike's not using the one that I sent him today. No. He's missing the one that I sent today.
Oh, that's fine. So, well, then I can't talk about my market update. I was going to do a graph. I had a couple of graphs in here.
I'm sending it to him again right now.
Well, then he's going to switch it out. All right, so I'll do market update later. So I was going to skip around a little bit, but I'll come back to the market update a little bit later on. It just shows some graphs about, kind of where we are. There was one of the participants tonight had some questions about like market and COVID and, how we're kind of seeing impact at a numbers level. So I wanted to be able to show some data because I like data, and I think sometimes seeing graphs is helpful, especially compared to like last year versus this year. But it also ties in kind of like to making offers and what that process looks like and how aggressive people need to be right now. So I will circle back on graphs, but I chatted a little bit about making offers. One of the things that sometimes we have to do is check with your lender on if there's a particular property that you really, really, really like, and you're like, I just want to make sure I can afford this. So, if someone, how do you handle that, Chris? If someone like sends you an address of a property and they're like, I love this place, does this fit? How do you handle that?
I handle that. We have a presentation called Mortgage Coach that actually I will break down, anything that we have talked about, but let's just say you do qualify for a couple of different programs. I can show you, 123 Main Street, and let's just say Haverhill for, the sake of saying it. And I can show you, here's what, your monthly payment will be. Here's what the down payment would need to be. And I can have it catered and specific to that exact home. That way you will feel not just, informed, but you can also see the numbers catered to that house. Because as Jess, and I can tell you is that every single city is going to have a different tax bracket. So your taxes are going to be different, whether you're in, a big one up near you is Haverhill and Amesbury, right? As I say, Amesbury is only 2 cities over and has a massive higher tax bracket than that of Haverhill. And similar down towards here, just in Salem. Salem actually is a lot higher of a tax city than if you were to go to Peabody. If you would go to Danvers, Beverly, they're lesser. Salem's up there actually now with Marblehead and Swampscott, which just even a few years ago, they weren't. And those two were a lot higher. So, and it changes because, I know I joke that, most of the time taxes go up, but that's not always the case. And sometimes the taxes do come back down. So I know Peabody has actually come down. Swampscott for the last 3 straight years, if I believe it now correctly, is their taxes have actually started to come back down because they were one of the highest in the state back in, it was like 2014, 2013. So that's good to see. And there we go. Mike's got the market update.
Graph. So we got some pretty graphs. I'll talk about them real quick. And I specifically focused on Essex County and Rockingham County because technically this is supposed to be sponsored by Merrimack Valley, Southern New Hampshire. So I wanted to kind of really hone it in. But a lot of these numbers are actually pretty indicative of most of Massachusetts. So in terms of, there was some year-to-date snapshots from this time last year / end of October, beginning of November, in terms of like number of sales, how many sales, and then pricing. One of the big questions that I've been kind of fielding since March is, how's the market? You know, how are things going? You must be really slow. Must be really hard. You know, so there's a lot of misconceptions kind of out in the market right now about how we're handling COVID and being able to kind of navigate. So I will say in March, just like every single industry kind of across the board, it was a screeching halt. And we didn't know how to work. Like, you know, particularly agents that are in and out of people's houses oftentimes and shaking people's hands. And we're very much like a lovey-dovey, like touchy, huggy person. Myself personally too. It was really hard to be like, wait a second, like, how do I interact with you? How do I go into your home? How do I make you feel safe with me? How can we continue to operate business? But ultimately we were deemed an essential business because real estate is a tertiary connection to all financial asset transactions. So we ended up, you know, being okay to continue working. But then it was about having a conversation of how do we work differently? So you can actually purchase a property totally remote, virtual, without actually seeing it, touching it, or interacting with a human. And so a lot of times we'll do some of our online interactive orientation meetings online. You can do virtual tours of houses. Your application with Chris can be totally remote. You don't actually have to go into Chris's office anymore. Everything's online. And you can submit offers electronically. You can send somebody to your home inspection. You can review the report afterwards. You can do your entire loan application online. You can meet with an attorney remotely over the phone. You can does Mortgage Network do a remote closing? Can they do an online close?
They need to get approved for it. But I mean, a lot of attorneys now, I've had an attorney that he drove to the people's house and they did it through a window. Like, so, I mean, attorneys have been very great with just helping out the client any way that they can. I have one where he did a courier system where he, you know, during the height of it, you know, when we had that initial shutdown, is that the attorneys were doing Zoom calls like this. The clients were there and showing, you know, their identifications. They were signing it, and the attorney had a courier sitting right outside to grab the paperwork and bring it right to the attorney's office. So, you know, they you know, rolled with the punches just like everybody else during this time.
So, and then closing, all registries are pretty much doing electronic e-recording, and you can have the keys mailed to you. So we figured it out. It took a little bit of bumps along the way, but we definitely figured out, you know, opportunities where we can streamline our system. So despite some of the misconceptions in the marketplace, there's still been a huge amount of demand, and our supply in the marketplace has been very low. So we don't have enough listings to support all the demand that the buyers have right now. And the fact that interest rates for loans are just screaming low. Like I call it free money. Like banks are giving out almost free money. Almost.
Yeah, the rates are low and they look like they're still going to stay the same. You know, it's all going to be driven by, unfortunately, again, COVID. You know, even with the vaccine coming, hopefully, knock on wood. But, you know, even with that coming, there was a lot of people that were saying, oh, the rates are going to jump right when that happens. It doesn't seem to be the case anymore because the government is just looking at how many people lost jobs, how many people were struggling, and they're just not going to all of a sudden just jump up everything right back on people. There's a lot of talk that they're going to keep things, you know, not status quo, but they're just going to keep things low and try to, you know, slowly grow back into where we, you know, may need to be, but that will be, he is this saying now, but we'll see.
Yeah, so the pricing on the percentages is a direct correlation to just supply and demand. When you have a really low supply of something and you have a lot of people looking for the same thing, it naturally drives up the cost. So that's kind of what we've been seeing in the last year, is that despite a pandemic, despite a recession, despite like record number unemployment rates, we still have rising housing prices, which in some way doesn't make sense, but it's because we just have like such low demand. Mike, can you go down to the next one? Can you scroll? Cool. So in terms of market activity, the little graph here on the right-hand side, it's kind of again, supply and demand. In 2018, those are approximately the number of, listings that were available. And then, so that's 1,603 in 2018 for Essex County, down to, we only have like 572 houses right now. So that's 1/3 of the inventory available within this quarter, same time quarter, like 2 years ago. So we have more buyers that are looking for the same types of products, which is driving the prices up. Mm-hmm. Can you go down to the next one? So similar kind of thing. I'm not going to beat a dead horse, but again, these are about trends just in a little bit over the last year and a half, kind of the number of new listing activity. So our office tracks across the entire state of Massachusetts the number of listings available, number of agreements, and the number of closed. And then we also track based on our individual office. So this is kind of a cool internal slide that our regional VP actually just produced last week, and we do a Market Monday. She sends out these slides every Monday to all of us. And this like dive on the chart has to do with the fact that it was Thanksgiving week, which is normal for that week to not take as many listings. But even still, like the yellow line is 2020. So we've just been, in most cases, trending lower than last year. We kind of made a little bit of a comeback in some normalcy towards the end of the year, but right at the beginning in March and April, it was just nope. People were afraid, and people were afraid to list their homes. People were afraid to have people inside them. People were afraid that they wouldn't know where to go, that they didn't have a place to go, that they didn't know like what they would do. So it kind of pushed our spring market to our summer market. So what our normal March and April and May look like, it became our June, July, and August. So, Mike, can you go down one more? And then this here's for New Hampshire. So I just wanted to chat real quick about New Hampshire, and I know we're trying to be mindful on time and we're over time, so I apologize. If you have to log off, we totally understand. I think this is going to be recorded and available on the website afterwards too. So if you got to go and you want to pick up at a later time, you're welcome to. So New Hampshire has been kind of a hotspot location. People are moving from Massachusetts to New Hampshire for a little extra space. They're looking for more square footage, but then also the price points have been a little bit more favorable for people, and they can afford more in their pricing. So, and can you go down to the last slide? My last graph, I think. But pricing in Southern New Hampshire, even though like Hudson, New Hampshire was on like the Hot 10 list this summer, I think, for on like the Realtor.com, we had like 4 zip codes in our region that met like the hot list. So one of them was Hudson, another one I think was Plastow, Melrose. I forget what the other one was. But so in terms of pricing,
on there too?
Huh?
I thought I heard Peabody made it on there too, but
maybe, possibly, yeah. So just some trending on pricing. So that's what I got for my market update. Cool.
So I know that we're going to be going over that hour, so I won't go too much into it. But Mike, if you can go to 24, I just want to do a quick little breakdown of the different programs so everybody could see. So, here's a list of, and as you can see on the very bottom, and many more. You guys are going to be getting this this presentation. It's going to also be on the alumni. So, you'll be able to see the breakdown of FHA, VA, and a little bit further on other slides, but I won't go too far into it here. But, first time home buyer programs, we do have a few of those, whether it be with mass housing or conventional. When you hear conventional, it's with Fannie Mae, Freddie Mac are the two major players. They're government based, not quite like FHA or VA. They're still self-proprietized, but it's just more of, this is the type of program. They're not as strict when it comes to qualifications as sometimes FHA and VA can be. They're FHA and VA are very strict when it comes to the property itself. The property needs to be standing. The property needs to not have chipping and peeling paint, cracks in foundations or walls. It needs to be in good standing order, especially with VA. The veterans, they've risked their lives for us. The least that we can do is give them a house that's, standing. VA has a great no down payment program as well. The same thing. You risk your life, so you can get 100% financing. FHA is as low as 3% down, and some of the first-time home buyers, same. They'll go as low as 3% down. There is one that will do 100% financing. It's under the state housing program, so mass housing is a big one, but also New Hampshire housing does have some as well. So, our slides do kind of break down some more of these. I won't go too far into it, just because of same thing, time constraints, but there are multiple programs to help you out if you're looking for, as it says, first-time home buyer, low down payment options, being a veteran, state housing programs, 203K. Those are rehab loans. Their main aspect of those is you're buying a house that needs a little bit of work and you currently live, let's just say, in your parents' basement, or you have a rental property and you can actually have that house be worked on and you can use the equity in that house to kind of pay for it and get it to where you'd like it. I mean, rehab loans are great. I've done 3 or 4 of them already this year alone that, the people, because of COVID, were staying with their parents anyways, that a contractor went in there and completely, you can't do a gut rehab. You can't completely tear it down to, nothing, but, you want to update the kitchen. You want to redo the floors. You want to, update a bathroom or something along those lines. That's what these rehab loans are great to kind of help out as well. So I just wanted to kind of go over a couple of the programs because I know we're kind of coming up on the time limit. So, not too much into it.
Did you want to can you talk about the FHA program a little bit more in depth? Because I think that one's very popular and probably would resonate a bit more, just like on the qualification side of it.
Yeah, it's just actually one down. So FHA, as you can see, minimum credit scores of 600. It was actually a little bit lower, but same thing, COVID has made that bump up a little bit. But, all you need is 3.5% down. So, it really helps out those people that, hey, you students, you're just graduating and now you're looking at it and saying, I have student loans, I have this. I can't all of a sudden put 20% down to make this qualify. Well, FHA is great with that, 3.5% down. It gets you into the house, now you have a low down payment. It's one of the best of both worlds. And as you can see, seller concessions, they allow those as well. So what that means is I have enough for the down payment of 3.5, but I don't have enough for the closing costs. Okay, well, you can actually reach out to the seller and have the seller pay them. Jess is going to be great. Yeah, that's where Jess is going to step in and be very helpful and put that on the offer. You have to let the seller know that this is what you're looking for. But, the fact that they allow 6%, that's huge, especially sometimes in this area, because, it's not that the closing costs are high, but with the housing prices high, 6% can actually end up being a lot of money to really help you out. Only on closing cost prepaids, and you just don't get money back. That doesn't work like that though. But there are no income limits. Some of those first-time homebuyer programs, they do have income limits. If you make too much, you unfortunately don't qualify. Similar thing with the no asset restrictions. They don't require, your assets can come from anywhere except from money under the bed. We still need to verify that it came in for a checking account, a savings account, 401k. You can get a gift from a family member. Any of those, it's just, I did have one person one time that said, I have 10,000 under my mattress. Well, that's great. I can't use that. I'm sorry.
I've had that happen too.
Yeah.
And they were like, why?
So I can't give you an exact interest rate over this. Similar thing is it's all based off of your credit score. There's a few other factors. I can let you know that they are, depending on it, could be in the high 2s or low 3s. But that's about the best that I can do. If you reach out to me later, we can certainly talk about that, and I can give you a more specific number.
I mean, am I allowed to say, like, I had a client that just closed an FHA loan last week, and it was 2.75.
That came from her.
It came from me, not from him. But it depends, you know, it depends on everyone's personalized situation, and there's rates in place, and you can sometimes negotiate those a little bit, but that's like a screaming rate. And really anything under 3.5% is like amazing. I mean, even 3.5% is amazing.
Yeah. And it also depends too. You said it a little while ago. Not just credit score, not just you yourself on what how drives what the interest rate will be, but also let's just say the seller all of a sudden needs 90 days. Interest rates are locked in 15-day brackets. So a 90-day lock unfortunately will be a little bit higher than a 30-day lock or a 45 because you're holding a rate for a lot longer. So that's why I can't give always exact. I can give you ballparks. I can give you, if I know 90% of it, because we won't know obviously about the property, I can give you a more specific, but without knowing all that information, I can only give you, the ballparks. But as you said, I mean, the rates are great right now. So
great. What else? I mean, we'll fast track to closing day, right? So you get an accepted offer, you start your loan application, and then there is an important step as part of the loan process. Do we have an appraisal slide in here?
23. It just says it. That's it, though. It doesn't really say too much about, but.
So the appraisal process of this is like a second inspection for the lender sends out somebody to check the value of the property and to also make sure that there is a structure at the address in which they're investing the money into. So banks aren't in the business of making poor investments, because they're partnering with you oftentimes on this property at almost 90 to 95% of the value, and you're only chipping in 3.5, 4, 5%. They have a lot of stake in the game, so they want to make sure that the value of the property and the condition of the property is saleable in the event that they end up foreclosing on the property, unfortunately, and having to sell it. So the appraiser or the appraiser goes out to the property, make sure that there's windows, doors, that the condition is good, but that also you're not overpaying. And that's been something that's been an interesting aspect this year is the appraisals. There have been a couple of instances that I've experienced with clients where the appraisals have come in lower than planned or lower than what the accepted offer is. And sometimes you have to kind of go back and renegotiate because the buyer thought that the property was worth X and offered X and was willing to pay X. And then the appraiser said, no, the property is not actually worth what you think it is. It's worth this. And so sometimes the bank will refuse to lend if the value is not where it needs to be. And it's an opportunity to, try and figure out a solution. Have you been seeing the appraisal side?
I've had a couple. So in those scenarios, there's a couple of different ways that you can obviously, if you really do love the place and you have the money to go and do it, lenders can lend off the lower of the two, the purchase price of the appraised value. So, on the flip side, if your appraised value came in higher, great. You got a house for more than it's worth. Don't say a word to the seller and close and be happy. If obviously the flip side and it came in lower, then unfortunately, as Jess said, you now need to kind of either come up with the difference. You can go back to the seller and say, here's what the appraiser came back as. Can we meet in the middle? Can we renegotiate this in some way, shape, or form? So especially with the lowest down payment options, there's not a lot of wiggle room when it comes to the lenders on being able to qualify you for something different. If you were putting more money down, the lender would talk to you and say, here are the options. So it hasn't happened too often, but I have had it twice this year. Once. I usually don't have it more than 2 times, knocking on wood, because I do have a couple that are coming in the next couple of weeks. Last thing I need to do is have those all go. But the appraiser's given, what the market value is. As Jess is going to do the CMAs, she's going to give her opinion of value, and then the appraiser is going to, back it up, defend it, or say, well, unfortunately, due to A, B, and C reasons, here's where the value is we have here. It can be renegotiated also with the realtors, that the realtors can come up with properties that say, no, this is where the value should be, we can always work with the appraiser to see if we can get the value to change. But you're trying to get somebody to say that they were wrong, and that sometimes is tough.
Well, right. An appraiser's job is an expert opinion of value. So if their expert opinion is that it's X, and you come at them with information that you think it's Y, and they don't believe that, then sometimes there's kind of like a roadblock there. And it's, they have a license too, just like agents and mortgage brokers too. It's, sometimes it can be hard to navigate that when you come across those hurdles, but figure it out.
Yeah, and the last two, at least, bullet points on this, obviously inspection. I know Jess talked about this a little bit before. Home inspections are not required. VA does require a couple of steps of them to be required, but home inspections are just recommended, although highly recommended, because a home inspector will go in and look at things that you don't, I mean, I'm a mortgage guy. I don't know how furnaces work. I don't know how oil tanks work. And they're going to go and they're going to give you a sense of, all right, the roof is 15 years old, or, the boiler maybe has 10 years left on it. They're going to at least give you kind of those big ticket items of something you're going to have to worry about, think about. I had one where a home inspector didn't even go into the house. Good friend of mine was buying a house down on the South Shore, and the whole, the roof was bowing. So he said that he just walked up, looked at it, and said, I'm not even going to go into the house. There was a huge structure issue right there. Wrote up a report saying it was a structure issue, and my client ended up walking away due to that. But, the home inspections, like I said, they're not required, although I do highly recommend. But Jess will, let you know as well. Sometimes sellers don't want to see those as a condition on an offer. So it's an ebb and flow situation there that Jess and any real estate agent's going to let you know, what way you'd want to handle that.
Yep, totally. Yeah, it's always a good idea. Especially, I never recommend first-time home buyers to waive an inspection. I think home inspections are an invaluable resource. It's a great opportunity for you to just understand how a house works, right? Like, how are all the systems tied into each other? Why is this over here? Like, what is the plumbing? And it's just like, you have a house expert for 3 to 4 hours to kind of go over a house with you, and you can pepper them with questions about all the things that you never thought that you'd want to know. But, sometimes it's like, those are the things you really want to know when something stops breaking, and being able to understand how everything is connected is really, really important. Particularly the systems, because when a system goes down in the house, it's usually a lot of money. And so if you know that and you can plan for that, then you won't be surprised. But if you don't plan for it and you don't know it, then sometimes it's a big financial surprise. So just like with a car, and oftentimes when we go through houses and do showings, I make kind of an analogy with a vehicle. There's normal maintenance items that you do on a car, like an oil change and changing out your windshield wiper fluid and getting your tires rotated. Oftentimes there is similar types of maintenance items for the house too. Getting your gutters cleaned, having your boiler serviced, your oil tank cleaned out.
The flue. The flue, right? You never would think about that, but the chimney flues are something that you don't think that to be clean, but those can cause fires. So
totally.
And the other bullet point is insurance. I know Jess and Mike were talking about this right before. You have your homeowner's insurance, which is just to protect your home. God forbid something does come up. There was an unfortunate fire or something. But there's also there's a big elephant in the room: flood insurance. We do live at least on the North Shore, but also Merrimack Valley. You have the Merrimack River. There are properties that are going to be in flood zones. Realtor.com has been a little bit better. MLS PIN though will let you know as well. Mm-hmm. Properties that now fall in flood zone areas. Flood zone insurances can come up to be very expensive. Not always. It depends on what flood zone it falls into. There are some that are, you may flood one every 30 years. But then there are others that, especially if you're right on the coast, unfortunately, you get the great view, which is fortunate, but you might have to pay a little bit extra for the flood insurance. So, those are qualification factors, because if, I do say, hey, you can afford $450,000, but then you find a house that's in a flood area, with that insurance, it may scale that. But again, that's where Jess is going to come in and let you know, hey, this house is in a flood area. We should let Chris know right away so that he can run the numbers and let you know what you could potentially qualify for, or if there's any type of roadblock here.
And insurance is a shoppable item. So just like with your car insurance, you can go to Geico, you can go to Allstate, you can go to Liberty Mutual, you can go to your little town broker. It's the same thing with house insurance. So insurance is a shoppable item. If you absolutely need insurance at the time of closing for your property. However, you can change it.
Yep, you can change it. You can change it right after. So if you needed it for at least get in the house, you can change it 4 months after. You just reach out to the servicer, myself, and just say, oh, I decided to change it to Joe Schmo's insurance company, and here's the new insurance binder, and we just updated on our end. So, that's the great thing with the insurance, because every year, just like the car, they're going to come back to you and say, here's your new premium, here's this. So, it's never a bad thing to shop around.
Right. And oftentimes the premiums will go up. So it's not a bad idea to, kind of keep shopping around for rates, just as long as your coverage is sufficient. You don't want to overpay for it, but you never want to skimp on coverage either, because insurance is one of those funny things that you hope you never need it, but then when you really do need it, you hope you have it. So the inspection, the appraisal is paid by the borrower. And then the home inspection is also paid by the borrower. So it's your inspection of the house to know whether or not you're moving forward. Generally, condo inspections are approximately $300 or $400. It depends on square footage and how big it is. And if they're inspecting multiple bathrooms, a ton of square footage, it just takes time for an inspector to inspect. So if it's a big house, it's going to be more. If it's a small unit with 1 kitchen, 1 bathroom, no dishwasher, it's going to be less. So usually it's the buyer that will pay for those things. And then the appraisals, what are appraisals running at right now?
About $450 for a single family. A condo, multifamilies can be, depending on how many, $550, $600. So.
Yep, and that figure is part of your closing costs.
Yes.
When you get your estimated amount for your closing costs.
Yeah, so the appraisal is, the inspection is not. So just keep that in mind, because again, like I said a little while ago, they are highly recommended, but they are not required. The VA one, VA, just so I can say that, with some of their inspection, it's they have a termite inspection that has to be done, and also in New Hampshire, if it's on a well, actually Massachusetts either. So both of them, if they're on a well, then they also do need to have a water test done for VA. That can be paid by either. It does not have to be paid by the buyer. Just a few years ago, actually, VA had it the other way, where it had to be paid by anybody but the buyer. But then so many veterans did say to VA, well, I want to buy the house. I want to pay for it. So they now allow anybody to pay for it. So, I mean, you're not going to really get a seller to pay for an inspection, because, the inspection is a spot where if the inspector does find something up with the house, that's where Jess is going to use that to maybe get a seller concession for closing costs, get something, or bring the value down, because all of a sudden, the roof is 25 years old, and the home inspector is saying it's only going to be another 5 years before it's not, you're going to have to replace it. So, that's why, as Jess said, the home inspector is a great person. I know when we did ours, he was here for 2.5 hours. We have a 900 square foot house, but, we asked him every question. He walked around, he checked every square foot of the house to let us know exactly what it is that we were getting ourselves into.
And there's a report that's generated from a home inspection as well that I joke around. It's a honey-do list after the inspection, after you close, because typically the inspectors will rank condition of items within the report. So things will be good, things will be fair, or things will be poor. And usually, things that are poor need to be addressed right away. And then there's other items that they will flag as well within the report, like health and safety items. So the best collateral, the best leverage that we have in renegotiating is typically on the health and safety items. So if something is a health risk or a safety risk, it's much easier for me to go back to the seller and say, hey, listen, this outlet is a fire hazard. It needs to be changed in order for my clients to close. Can you do that? And at which point they're like, oh my God, I had no idea. I'm so sorry. And they run and get an electrician and they fix it. I don't have a whole lot of leverage if, I have a buyer that comes and says, I don't like the paint color.
Yeah.
No, that's not going to work, right? So like focusing on the health and safety items is where we tend to have more traction versus on cosmetic items or personal taste items. That's not why you're buying a house. But do we have any other questions? I don't know who else is still on.
No. The only thing that they would have to do is fill out a gift letter. Depending on the program, we may need to see the bank statement where the funds came from. But with most of them, it's just the gift letter, see the check that they gave you, and then your account that the funds are just going into for the down payment. So those are usually the only things that we really need when it comes to gifts.
Yes.
Yes, they can. It's, with my company, we're going to send you out a video. You can still use your credit cards as normal. A great example, I have a friend of mine that she thought she couldn't use it at all, and all she was eating was Annie's mac and cheese and drinking Bud Light for a month. And then her now husband, but fiance at the time, said, I really want to take her out for her birthday. Can we go out? And I said, you guys can still go out and, buy groceries, do whatever you need to do. It's just don't go get a new car. I had a guy one time who went and bought a brand new car a week and a half before closing. Well, that changes your qualifying. That could change your credit score. That could change a lot of factors. But I mean, if you're just living your normal life and, you're paying your credit cards down, but if you, charge groceries or whatever, your score shouldn't change.
Cool. Yeah, I just tell people to be normal. And I'm like, don't go buy that Lamborghini that you wanted to buy. You're going to have to hold off on that one until after the closing.
That's what the guy bought.
Really? Oh my God. Mike, can we go to slide 33, which has got like just our contact information? Yeah. This is us. This is us after the fact. If you ever need to reach out and have questions, and we're going to definitely stay available for a couple more minutes, I think, until in case anyone has other questions that we can answer. But I know it's a little bit later than I think that we planned on, but we've had amazing questions and, great interaction. So I'm excited to see that. And if anyone else has other things, we're definitely available. But we're also available after this too. So this is Chris's contact information. This is my contact information. I use my social accounts pretty regularly. So I have a Facebook business page, and you can find me on LinkedIn. I don't use my Insta that much for real estate, but you can definitely like my business page. You can be friends with me. I like friends. Be my friend.
Facebook, LinkedIn, and I do have my Instagram, but same. I don't post on it as much or as much as I should, as my marketing department tells me often. But you can certainly find me on there. If you have any questions or anything specific, you can send me a direct message on them, and I can also answer as well.
Cool. Thank you, everybody. And thank you, Salem State, for allowing this platform for us to kind of be on here and chat with you and hopefully demystify the process a little bit. It's not that scary. It's just very process oriented. And once you kind of figure it out and you have a good team, having a good team, I think makes or breaks it, honestly.
Absolutely.
Yeah. So.
Well, we want to thank Chris and Jess for their time tonight. And I just want to put in perspective for anybody that's still watching, as somebody who just recently completed the Merrimack Valley Housing Partnership's first-time homebuyer program. This is roughly 12 to 14 hours worth of information that's presented to you, tried to condense down to 90 minutes. So there's a lot to cover here. So don't worry, we're going to share the slides with you after the program's over. You'll get a link to watch the recording again. There'll be a resources tab on that page where the slides have already been uploaded to. So if you have any more questions, or if you want to do a little bit of a deeper dive into the presentation, sorry about the technical difficulties at the beginning. Jess and I had been scrolling through it for 30 minutes before we started, and then right when I hit share, it stopped working. So such is life.
Okay.
But that completes the presentation tonight. I would encourage you, if you want to learn any more about this topic, to check the recording page out when you get the email. Learn about some of the other workshops that we're offering by visiting alumlc.org/Salem State. And if you have any other lingering questions that you don't think of after, or that you don't think of until after the presentation, I would encourage you, as Jess said, to reach out to either her or Chris for more information. Their contact information is on that final slide of the presentation that we shared this evening. Other than that, I think at this point that will conclude the presentation for the evening. Again, thank you to Chris and Jess, and thank you to everybody for watching.
Thanks.
Thank you.